Welcome, welcome. You've just entered the trading pit. Your home for sophisticated takes on the crypto markets. It's March 12th, and here in the studio is JJ and Ben Lilly of J Labs. As always, I am Marconi White. So happy to be here. And today we're going to be starting off with rapid fire. Ben, JJ, I hope you're ready. All right, let's get going. All right, so the first question is DeFi or DePIN, Ben Lilly?
DeFi.
Quick. It's rapid fire.
DeFi.
All right. Okay. I that was a softball one. I have to say. All right, JJ, 80 or 60, which comes first?
Ooh. I'm going to say 80. I'm going to go with it. 80.
Oh, I love the little bull coming out. All right. I like that. Ben Lilly, proof of work or proof of stake?
Proof of stake.
Oh, again, I think that was a little bit of a softball, but maybe it's like 60-40 rather than 90-10. All right, JJ, trading view, light mode or dark mode?
Dark mode.
Oh, of course.
Need to be gentle on the eyes.
I was thinking something about your soul, but we'll move on.
Yeah, that too.
Ben Lilly, last one here. Bored Ape or Mutant Ape?
Bored Ape.
Okay. Yeah, I think that was the original, if I'm not mistaken.
OG. All
right. That was the OG. Yeah, you got to. The OG in crypto means it happened about 6 minutes ago. Okay.
No fan of delusion.
That's right. Not good for the markets. All right. Well, let's dive into today's story. Everyone who's listening, welcome. Glad to have you here. I know everyone saw yesterday Bitcoin closed above its previous all-time high, creating a new all-time high. I think it's currently sitting at about 72K. But there's some signs that we may be looking for a bit of a cool off. Interest rates for borrowing have picked up significantly in DeFi. Aave is seeing stablecoin borrowing of 20 to 40%. MakerDAO just increased their rates to increase stability for their funds. So Ben, tell us, do these changes suggest a local top?
It's not helpful to continue to run higher with these rates. And you just kind of think of it as margin. People saw that if you were to go ahead and borrow this capital, and you would go ahead and pay at the time 6-7%, like there was enough returns out there to go ahead and do that action. But as now we're creeping up to 20-40%, you're seeing on Aave the utilization rate I saw at like 92%. And so people not familiar with how Aave works, it's like a hockey stick in terms of the rates at which you would have to borrow. So when it kind of hits 90%, it creates this hockey stick where the amount of that you have to pay just to borrow that capital just goes parabolic. And so it was running between 20 and 40% at times yesterday. And MakerDAO went ahead and raised its rates. And the reasoning behind that is pretty nuanced. It has to do a little bit with trying to keep DAI pegged to $1 and kind of how DAI is moving throughout the market and individuals seeking other opportunities for yield. One of which, Athena, kind of a new app where it does delta neutral positions and harvests funding rates, getting great yields in this current environment, understandably so. But if we go ahead and look at MakerDAO rates, think of it like the Fed. Fed goes ahead, raise rates. What happens? Cost of capital, cost to borrow, the cost of money goes up. And so that tends to slow growth. So this chart right here is actually the average fees on ETH vaults and wrap staked ETH vaults as well. That's that blue line right there. And you can see even in 2021, rates went higher as price started to climb. And eventually that kind of helped constrict it. And then it happened again around 2022. And we see right now it's running high. And it's a little bit higher now because of the way that staked ETH, wrap staked ETH, and kind of this native yield of ETH in general is creating sort of a real borrowing rate versus the actual rate that's advertised. So that kind of difference makes it a little higher. But anyways, point being, rates are going up, margins are getting squeezed. It's a little bit of a cap on price action here moving forward. And
I want to, you just talked about a little bit of a cap on price action. I guess from a mechanics standpoint, JJ, we were talking offline. A lot of this lending is being used in the perpetual market, right? So this is actually helping drive some of that market.
Yeah, you see it all over. Like, I'm sure people take that and they go jump into various altcoins that are popping off, meme coins, etc. It's just they need access to more liquidity, and they need that liquidity to speculate. So obviously, the more people that are doing it, the cost to borrow it goes up. And it's just kind of a natural supply and demand mechanism there in the market, where the higher these rates are, it just means more people are speculating.
Okay, well, I think two signs that we could start to see a local top. Ben, is there anything that's really going to be an additional signal you're looking for to really say that this is coming to a crescendo, right? Or is this just something you continue to monitor? Is it going to be a lagging or indicator? Or is it going to actually foretell the story?
Well, I thought this morning, CPI would create a little price action to the downside as it comes in hot. And yesterday I made a tweet that said the BTFP program that the Fed was running, there was almost headline news that, hey, it's expired. The assumption there was that the market is almost looking for an excuse to go ahead and correct. And it was a bit surprising. Now we have two sort of opportunities for the market to react, and we haven't seen it. Okay, so that's kind of a little bit of a tell right now. And for anybody that is listening, I wish we could almost edit this out at a later date to give the alpha to those that are listening. We even got Pablo alerts that were coming in last night. And so that was just further indication that, hey, look, like things are starting to turn a little bearish here. Like we just need to pay attention.
He always trades around the dollar too, right? His movements typically around DXY.
Typically, yeah, he tends to be more of a macro actor. And so if we pull up the DXY, I'm sure we're going to bring it up later as well, but you can kind of see that it went ahead to inverse head and shoulders down here on the 8th, and it's starting to generate some strength. And then there you got kind of the movement on the CPI news this morning, that it was coming in just a little bit hotter than expected. And now DXY is running hot, which is really just indication that, hey, look, the Fed's going to have to stay sort of higher for longer, a little bit more hawkish. The ball's in their court to do what they want.
So if you're sitting in risk assets, if you've got most of your stack sitting in Ethereum and Bitcoin or whatever the tokens, you may be looking for a little bit of cool off. At least that's what some of the larger participants are looking at. But I want to actually get into a little bit around sort of the larger trades, a trade that's been going on for a while, which is the Bitcoin miners, because I think we're having some interesting data come out of that. I saw this data, it was on the block. It said that Bitcoin miner treasuries are now worth 131 billion. Obviously, that's coming as Bitcoin has gone up all the way from 40 to 72K just in the last couple of months. But despite that, the miners have had a strong sell-off. And as Caleb Frazen, hopefully I got his name right, on X noted, Bitcoin has outperformed BTC mining stocks by 18% since 2023 and 88% in 2024. So JJ, I'm curious, is this trade dead? This idea of the miner stocks being a beta trade, is it dead for now? Is it going to come back?
I think fundamentally their value probably has never been worse than it is right now, considering I believe there was a White House order that came out that's really nailing down on Bitcoin miners and taxing their energy use and whatnot. So you have kind of that flow of people trying to get out miners for that reason. Then you have people front running the halving, which is going to eat into their revenues. So obviously they're getting really beaten down, but you just see how hard this chart is to time, right? It's hard to even make sense of it. This is just Mara. This is one of the biggest ones. The smaller ones are even more volatile. So it just goes in these crazy ranges, and this leads to overextensions at times and then oversold conditions at times. I do think if Bitcoin gets above 80K, you'll see these bounce back probably 20 to 50% or so. But again, it's going to be one of those trades that you have to be in and out if you are planning on that, because you see this chart, it doesn't maintain price action for very long in either direction. So the only thing you can really bet on here is continued volatility in my perspective. But I don't think it's dead completely. I don't think there's a scenario where Bitcoin goes up to 100K and these things continue to get sold off. I do think they'll bounce back and likely outperform Bitcoin on those larger jumps, but then it's a matter of getting in and out.
Yeah, so not a buy and hold, really a buy and trade.
Exactly. Yep.
And definitely, I would imagine some of your option strategies could apply equally to these as much as they can for Bitcoin.
Yeah, when they get sold down like they did yesterday, if you think Bitcoin's going to continue up to 80K, I think they're still pretty compressed in the pre-market, down about 30% from last week's highs or so. Mm-hmm. So you do have some good risk reward on call options there if you think Bitcoin's gearing up for 80K plus.
Okay. So for all those out there that are asking about this trade, obviously, as JJ just mentioned, it's a bit beaten down. Doesn't mean it can't come back. So definitely something to look at. rotating into at a later date. And definitely, I want to give a shout out. JJ's options video came out last Friday. If you haven't seen that, definitely suggest you giving that a look. A lot of really good feedback on that as he starts to talk about trading these different phases that we're getting into. I want to give a shout out to everyone who's out there. 251 Legacy Trail, JV, David C, Huddle Gone Tight. I probably didn't pronounce that right. And Adrian and David C. Guys, welcome. Glad to have you here. It looks like a bunch of people from Seattle got up early to listen. We are asking a question today, which is this a good time to be watching the show? Would a couple hours later actually work a little bit better? We've kind of debated internally whether or not we should do it right around the market open. There's usually a lot of activity, which gives us something to look at, or should we do it a little bit later in the day after we've seen the markets digested some of the information? So let us know in the chat what you're thinking about. If you're watching this afterwards in the recording, obviously add in the comments. Thinking maybe 3 to 4 hours later would kind of be the window for us. Okay, let's kind of get into the market now. As I said before, Bitcoin's trading, I think, at 72K as we're recording this. And we have a couple of macro headwinds we talked a little bit about. We touched on that. I guess, JJ, from your perspective, I was looking at some of the numbers. The ETF still came in strong yesterday, despite GBTC selling out 494 million. We saw a net increase of 505 million coming into the ETFs. Perpetuals were still up as far as I could tell, and volatility has spiked as well. So tell us, what are you seeing for the market? What's kind of caught your eye to tell us, where we're headed next?
I think the biggest story of today is that everybody was very risk off ahead of the CPI. And that, like we've been saying, when the market is too overhedged, it just creates that friction to the downside, so it doesn't manifest. So we'll have to see what happens today, but I'm guessing that's why we didn't see the sell-off, is because everybody, you can see it here on the long short. So as soon as we went over 70K on March 6th, people began to hedge. So you see this ratio dropping off, which just means more shorts are entering, likely an aspect. Some of that has to do with cash and carry trade, right? The people on the opposite side of that are taking short positions against the people who are holding spot. So you see like this kind of natural hedging, and that's just creating friction to the downside, where the path of least resistance, as crazy as it may seem from here, is still up. So if everybody's waiting for a pullback, the price might have to move higher before we do get that pullback. We have all these overextensions and reasons that it could happen now, but we've even had the hot CPI print, right? And that the coin's still trading above 72,000. So it's just momentum here, and there's that need to hedge. And as long as people are not going full in, right? Like where we don't see people full extended long, reckless abandon, as long as people are hedged, it can keep moving up.
Ben, I want to ask you kind of a similar question about, if we're looking at the markets. JJ just mentioned that, we're looking a little bulletproof even against this hot CPI, which I think came out at 3.2% year over year, 0.4% since February, hotter than expectations. How long can Bitcoin remain bulletproof against that?
I mean, it's been proven resilient for it. It's like, just look at the flows. I mean, right here, this is the far side table where they go ahead and keep track of Bitcoin ETF flows day to day. And you can see on this left column over here, IBIT, and you can see just destroying all expectations. And it continues to do it week after week. And so it's not an elephant in the room. Like, we know it's there. We've addressed it. And it continues to really just blow away the expectations that we all had of what's going to happen with this ETF. We all knew it was going to be big. We knew it was going to kind of shatter expectations, but this is market altering sort of movements. And that alone right now, that dynamic in this market means it's almost like the mentality of the honey badger, Bitcoin honey badger, where it just doesn't care and it just keeps going. That's what's happening right now with BlackRock. It is the honey badger in the markets. It doesn't care that things are overextended. It doesn't care that market makers in the options market are almost positioned not in a positive environment for continued upside or downside. And you can almost see, like JJ keeps bringing this up time after time, is just they're almost responding less. They're almost reacting. That's probably the better way to put it. They're reacting instead of being in a position ahead of time, which is what we kept seeing kind of in 2023, right? They would really kind of tip their cap of what's going to happen in the market. The market would make its move, and then they would reposition, and then the next leg up would happen. This is a little bit more responsive, and it just kind of shows that these expectations for all these legacy players within crypto, essentially native crypto players, this has taken them, by surprise, even to this day. So how long can it last? I mean, you can't have an expectation. You can't put in your mind like this is only going to last 1 week, because 1 week's going to come and go, and you're going to have to say to yourself, I need to keep an open mind. And so all we have to do here is just keep watching the flows. If they start to taper off and you don't see kind of CNBC covering it anymore, like that should be a hint that it's coming down. But until then, we just have to keep an open mind. I was getting kind of bearish signals yesterday. That's why I made that tweet on the BTFP. I thought that it was just coincidence in terms of timing. Like, hey, this is going to be a great excuse that the market's going to drop. We're going to blame it on this. But it hasn't, and CPI was another prime opportunity, and it didn't. So we have to stay open-minded here and just let it continue on until we see something different, and just try to protect yourself to the downside, but not miss out.
Yeah, so let me ask you about that, because something that's going to change now that is probably unfamiliar to the crypto markets, right? Your retail doesn't do any kind of rebalancing. If they're expecting to have Bitcoin, Ethereum, or crypto largely as 1 to 3% of their portfolio, they're not rebalancing as it becomes oversized. How much of a shift do you expect? Have you thought about in terms of whether or not these funds that are now allocating to the ETFs, if that starts to grow above what they planned on allocating, how quickly they'll rebalance? Like, are we expecting something in the quarter? I put out a tweet yesterday talking about some of the points that you just made. We have these programs starting to unwind at the Fed, potentially restricting liquidity. At the same time, some of these funds, I have to imagine, they're already over their allocation, potentially. So are they going to rebalance in a quarter? Is the first rebalancing going to happen in Q1 of 2025? Is it possible that people would increase their allocation having seen the performance? What's your perspective on that?
Yeah, so there's that random walk kind of discussion of the market, that it's just a constant random walk, but it's almost a constant drift higher is sort of a different school of thought. And that's just due to these passive flows that every Friday the paycheck comes in and $100 gets added to probably more than $100 to a 401k or an IRA within the US. And I'm sure there's other retirement vehicles elsewhere that it's just the same principles. And where do they go? A lot of these funds are starting to add some Bitcoin allocation there. So it's going to be part of this constant drift higher as more and more capital starts to enter all these vehicles week after week after week. Now, if you go back to the 1990s, and so this is more of my personal theory, that the markets aren't so much, that they're more about access to wider markets. And it's all about, if there's more participants, more users, that's going to drive asset prices higher. And so all it really becomes is, are you going to be selling items within your street? Or are you opening up shop in a mall? And now you got access to a whole bunch more consumers. And so if we think of what happened with the internet in the 1990s, and we go ahead and pull up like the S&P 500, you can see there was just a constant run up back then. And trying to get my chart to show up back in the 1990s. I think it was like 94, it was making its move. And that was really just online brokers accounts that were just opening up. And then you had this solid rally that just took place for like 5 years. And gold came in around the same time frame. And so if we think about, here you go, here's online brokerage accounts coming on, and you just have this constant march higher, because now you just have so many more people coming into the market. Volumes were being driven up, and it was just changing the game. And so that's what's happened with crypto right now. It's getting access to wider distribution, wider share, and it's also access to this constant, week after week, $100 bill hitting this mutual fund or this vehicle that's just adding capital to Bitcoin, continued additional exposure. And so now we're just going to have this constant drift higher, so to speak, for what Bitcoin is.
So if I could summarize what you're saying, the risk of a rebalancing having any material impact on those ETF flows is relatively low as we're in this period of constant drift higher, which is really about constant expansion of access.
For every portfolio that has to do that reallocation and shifting assets within its portfolio, you got two more that are adding exposure. So in these early innings, it's insignificant in my mind. In 5-6 years, yeah, we can probably give that greater weight.
Okay. Well, for all those who were asking about whether or not those rebalancing was going to have any material impact, I think you have a perspective from Ben. I want to see, we have a bunch of questions in the chat, and some of these I think we can try and get to. Some really good questions from all you out there. It looks like we have some questions about miners, some of the bills that have been proposed recently. We've got another one around something around the ETFs industry. I have to get back into that. But for all those who are out there, thanks for joining us today. Definitely hit the like and subscribe button. Be sure to share this with anybody who's looking for some sophisticated commentary on the market. Definitely want to get this out to as many people as possible as we continue to grow the channel above our 1,000 subscribers, on the way to 10,000. I know we'll be there shortly. JJ, I want to come back to you in terms of the market. So it said in terms of what you're looking at, we're looking at Bitcoin being bulletproof. You're not seeing any immediate risk signs coming from the market. If you look at the spot, which continues to be very strong in terms of the ETF flows, perps and options, nothing's really giving you a signal right now that we're going to see an immediate pullback.
No, I think obviously the open interest rates are alarmingly high, but a lot of that, as we said, it's due to the cash and carry. So until we see that close out, and it doesn't seem like people are interested in taking profit at 70 on those trades, there's obviously still so much premium baked in that you can have Bitcoin exposure and get paid for it basically throughout the course of the next year or two. Whenever this premium dies down, people are going to capitalize on that. You basically own the spot. You short, I think on Friday, December futures were trading around $9,000 premium. I'm not sure what it's at now, but there's a whole lot of just free money sitting there on this basis trade that's still too attractive for people. So as risk assets are going up, this is an easy way to grab basis. So you see it here, 23%. Just list down the different contracts you can short against your spot holdings. Like on Deribit right now, the December 27th, 2024 contract is trading at 82,300. So that means in order for you to lose money on this short trade, Bitcoin would have to be above this price in December. So you could basically buy spot, short that, and you collect that $11,000 of difference straight off the bat. And if Bitcoin crashes to 50K, these December futures probably fall to like 55K. So you make a whole lot more on the short side than you lose on your spot holdings, and you're just perfectly hedged. So there's too many opportunities for people to do that for it to necessarily crash right now.
Do you see any of this activity capping the upside, the potential upside? We've talked about definitely being over a 6-figure Bitcoin. We talked about the fact that this pacing has been a little alarming. Do you put any stock in that? Does this say hey, if these trades continue to be very rich for the traders, is this going to potentially cap the top side, which was a little bit what we saw in the previous bull cycle?
Yeah, it's always a give and take, right? So as you have these people entering because they're doing the cash and carry trade, eventually they'll exit, and that's going to lead to spot selling and just unwinding in perps. You'll see massive washouts. That's just kind of the nature of it, right? Is that when things go up in a straight line, inevitably at some point they go back down in a straight line. So just be prepared for that. Sooner or later, these positions have to unwind. It's just the nature of it. They can't just close out these. They've been short, since 50K. You can't just eat the losses on the perp shorts and not close out your spot to cover the losses that you incurred on the perpetuals. So there's going to be spot selling inevitably when this trade unwinds. But that might be at 100K, might be over 100K, might be at 80K. We don't know, but we haven't necessarily seen signs of it unwinding now, which means it's still going on. And as long as it's going on, don't fight it.
So as long as we see ETF flows maintaining, as long as we see this basis trade continuing, I think you can expect more upside, unless we see a macro event that changes things. And I think that's where I want to get to next. Talk a little bit about the Dixie. I also want to get into the possibility of the liquidity event we've touched on several times on this show, because I think there's a couple of factors that seem to be playing into that. Before I do, again, welcome to everybody. I see Hello World has joined us from Toronto. Glad to have you here. If you haven't already, hit the like and subscribe button. Definitely share this with as many people as possible. And if you're looking to follow JJ on his options trading journey and you're looking to do some of that yourself, CoinCall is the place to do it. Definitely check out that description, the link in the description. It's a great place to trade spot options and futures. Options just like what JJ does here and talks about either in his options video as well as what we've highlighted on the show. You can see it right now. It's got a very elegant interface, competitive fees, exactly what you need to start your journey, whether you're doing paper trades or actually starting to execute some of those trades directly. Definitely check out CoinCall. And if you haven't, if you've got questions, you're wondering more about options, some of the language feels a little foreign or alien or complex, definitely check out the options videos. We have an entire link just with the videos that JJ's created. They can start to break down some of those complex concepts into things that you can start using today. Okay, let's move into the Dixie. I was looking at it before the show started. It was trading at 102.83, so it appears to be broken down against the 103 range. We were kind of looking at the 103 to 104 range. We've talked about this usually being a signal that we may start to see some risk on. I don't feel like we're really seeing that just yet. So break it down. Are you expecting this to go much lower? Especially with some of the CPI print, and if so, I mean, what's the impact you're expecting to see on Bitcoin?
So what I want to see it do now, like this is just a bounce back from oversold conditions. That's all I see it as, is that we had that massive washout last week. Now you have the hot CPI print and it's bouncing back, but it hasn't regained any of its key levels yet. Like you see the 50-day moving average here in green, the 200-day in red, and you see these trend indicators are flipping down. It's lost the 50 RSI resistance on the daily as well as the weekly. And we kept pointing that out as a key line. Like while it was consolidating here, it was remaining sticky, but then it eventually broke down. We saw Bitcoin shoot over 70K, right? And it looks to me like this is the Dixie wants to break down further ultimately whenever this rally stops here. As long as it doesn't get back above like 103.50 in the days to come. If it continues to revert, I think it'll take out these lows. And I think we may be targeting sub 100 on the Dixie. That's kind of the levels I have in mind. So obviously, I think it would be risk off if it gets back above 103.50. But for now, I'm just looking at this as like a bounce from oversold conditions. It might give a nice Bitcoin entry opportunity. Like say it goes back up to 103.50 and rejects. We could see Bitcoin possibly below 70K at that level. And if you see the rejection, that might be a good time to enter.
JJ, I want to ask you about this liquidity position, the Armageddon that we've talked about. I'm going to ask Ben about that in a moment, talking about a couple of the factors. But what happens if that occurs? If you do see that liquidity event, how are you expecting the Dixie to react?
We'll see it firmly over these lines. Like I think, so let's take a look at what happened during COVID, because it could be similar here. So you see in February, it sold off strongly, and then you just see it shoot back at rapid speed. So if you see any price action like this from the Dixie in the weeks to come, like just this straight green candle back over resistance, regains all its trend lines, that's your risk off signal for sure, right? Like this is get the hell out here. I think that would be a pre-warning that we're entering some kind of liquidity crisis if you were to see price action like that from the Dixie where it regains that momentum and starts turning to the upside. You would see probably mass carnage in markets and whatnot, but I don't think we're there yet. I don't see it happening like this week, but it's definitely something to keep in mind. Like if it starts getting that momentum back that it lost over the past month or so, don't fight it. We saw how much damage it can wreak multiple times, right? Like just over the course of January. So we had the ETF happen in January 10th, but you see how strong Dixie was running up beforehand. Like it gave you this warning signal, hey, the ETF immediately, it's not going to be as bullish as you think, going to be a bit of a sell the news. And then it just kept running hotter. Bitcoin fell to below 40K. And I think you'd probably see something similar like that with Dixie. If it gets back above here, Bitcoin's probably back at around 65. And if it keeps churning up, that's probably not the dip to buy until you see it start to reject.
Ben, I want to bring you, excuse me, I want to bring you in here and talk a little bit about the Armageddon event. I know a couple episodes ago, we brought that up. I think a couple of the members were joking about the fact that, is this still on the table? But we alluded to some of that at the beginning of the show, right? We talked about the CPI print being hotter. Maybe that was a sell, looking to see some selling off in the market. Hasn't really materialized yet. We know that the BTF P program just ended, the term program that was supposed to be helping liquidity with banks. We know that there's discussions. I think you've highlighted those. I think banks are asking treasuries to be treated differently. And I believe Joseph, let me see if I can pull this up here. Joseph Wang, the Fed guy, 12 on X mentioned there's a potential change in leverage calculations, which could make banks a limitless purchaser of treasuries just as future issuance is surging. I'm pretty sure Joseph must be reading your material because you've talked about this. So in your mind, where are we in this liquidity event, and how likely is it, given that we see, again, the programs from the Fed starting to restrict a little bit, seeing CPI come in a little bit hotter? What is your perspective on that liquidity Armageddon? How quickly are you still thinking that this is something that could happen?
It can absolutely happen. It's conditions right now are really in the Fed's court. They did concede with the banks regarding Basel Endgame. That probably flew under the radar for a lot, but the banks have been pushing back because they have to increase collateral requirements, and Basel Endgame comes from Bank of International Settlements, and it puts a lot of just compliance costs on the larger banks, especially I believe they call them systemically important kind of sovereign banks, if you will. And in saying that, they won that little battle. So the Fed's not really in the greatest negotiating standpoint at the moment. Now that CPI is running a little hot, but you don't even have the market responding to it. So they're kind of lacking a little bit of leverage at the moment to go ahead and do some of the things that I think they ultimately want to do. But they're doing a great job, though, at the same time. They're not forced to really take any drastic actions at the moment. They have the repo market, which acts as dry powder and a release valve when things kind of get a little bit rough in the markets, as well as in the treasury markets. And Yellen's getting ready to start issuing some treasuries. And they're in a position, they as in the Fed, as they're rolling off their balance sheet, to go ahead, instead of reinvesting into mortgage-backed securities, I believe they've expressed a preference to go ahead and kind of put that rolling off capital into treasuries, kind of just change their portfolio and their allocation to that front. So they're in a good position moving forward right now. So is it going to happen tomorrow? It doesn't appear so. Is it going to happen next week? We're going to have to take it week by week. Right now, on my screen, I put up the 30-year yield chart. And if the Dixie's going to pass 103.5, as JJ mentioned, that's kind of this inflection point where it starts to flip resistance and try to turn it into support. Those momentum type of movements would ripple, and you would see the 30-year start to climb into 4% in terms of its yield, which would be a little bit of a warning sign that the Fed, because the conversation is just starting to materialize that, hey, maybe the Fed might raise rates. That was not even on anybody's radar 3 months ago, right? That it was nowhere to be seen. No one would even dare to think about it. But you're starting to hear some of these bond managers start to price in the possibility that, what? Maybe we shouldn't be thinking about a cut. There might be some probability here that they raise 25 basis points. And what's the market going to do there? I haven't given it any thought, to be honest with you, so I'm not going to try to fumble my way through that thinking, but it would cause a lot of individuals to rethink their portfolio, to rethink their end of the year strategy, and of course 2025 strategy. And what's that going to do? It's going to rear its head somewhere, and of course treasury markets is a great place for it to rear its head, right? You're going to see rates start to climb like you've essentially never seen before, because if the sign ahead is that the Fed's okay raising rates, then why is the 30-year yield so much lower than the front end? So you're going to have this massive spike, and the Treasury needs to go ahead and dole out all this debt. This is going to cause some dislocations in the market. So something to keep in the back of your head here. I wouldn't put it in the forefront. because it's not really showing itself quite yet.
I think that's almost the reason why they wouldn't, though, right? Like they know how much, like they raise rates, the market collapses, they're right back to cutting rates, right? Like it almost creates that kind of dynamic there where they would be creating their own problem by doing that at this point.
Well, you and I were talking late last night, JJ, about what happens if inflation's running hot and you see these events where you would think the market would correct and assets would start to come down, but instead they start going up. And it's kind of like that moment where it's like, oh boy, that's not supposed to happen. What does that mean? That means everybody's just trying to get out of the dollar and get into all these different assets because they don't want to hold essentially the cash is trash mentality. So what happens there? You
see it in the gold chart, right? Like that's had a little wick down now, but it's been trading at all-time highs despite interest rates being at 5% or whatever they are now, despite Dixie being over 100. Like the market's telling you more inflation is coming. This is very similar to what we saw in the summer of 2020, right? Bitcoin was running hot, gold was making new all-time highs, and the market, you saw risk assets going to absurd levels, but the Fed didn't care. They weren't worried about it. They weren't worried about inflation at that point. It wasn't an issue. And it seems to be kind of that same mentality now, where they are content with saying inflation's finished. And I think you see that in the market's reaction today. Like typically, if you think of 2022, anytime we had a CPI report that was slightly over expectations, the market was down 5-10% Bitcoin. But now you see this kind of inverse reaction where it's just like, okay, it absorbs the selling on the news event, and now it's right back up over 72 too. It seems like a change in regime in terms of the way the market digests these news events now.
Yeah, I agree on that. It's kind of getting almost like too complacent. And so if there were to be some turbulence ahead, I think one of them is just like the market responding to the fact that, the Fed could raise the rates. What does this mean? And then everybody has to essentially get back to being on sides here with the market. But right now, everyone essentially is all about, we're getting a cut here coming up in May, June, somewhere in there. Maybe we're going to get 75 basis points lower for the year. If that just changes a little bit, I was checking out the futures market to see what the expectation is and probability that what rates will be, and it hasn't reacted yet. So that mentality hasn't hit, but just know that that is starting to percolate in some of the bond traders.
So I think for all those out there trying to understand how to put this into their trading strategy and plan, I think it's having some ability to hedge should we see the market start to change. Obviously on here, we'll be tracking to see as I would say, I can't remember the exact name of the chart, but there's the one that shows all the probabilities of a rate, cut rate, staying neutral or going higher.
CME FedWatch tool.
CME FedWatch. We'll definitely be covering that because I think you'll see this a little bit telegraphed. I would be very surprised if everyone is expecting a cut and somehow we get an increase. On the day of. I think that would really throw people off. And I'm not sure if the Fed is quite ready to do that.
You'll start to hear some of the governors mention it first in some of their Fed speak, and then see how the market responds. You'll see just what is that temperature gauge. I guess they call it a weather balloon check. And if you start
try to price it in beforehand,
then that's your warning sign it's coming.
So I imagine for all the listeners out there, they want to start getting into this idea of how am I positioned? We had a comment earlier today from David C asking about ETH, Sol, Link, or INJ. Which one you think is going to bring the best returns in this cycle? We've got another question here from Adrian asking about miners. Concerning miners, thoughts on the latest proposed 30% tax on these activities? All of these questions center around positioning. What are you sitting in cash, waiting for a new point to get in? If you are allocating, are you looking at specific alts? In the case of Adrian, he's really asking, are some of these impacts from these proposals going to hit the miners disproportionately, and would that make that trade not as strong? So I want to talk a little bit about that, use the remaining time today to get into that. Before I do, again, welcome to everybody. Hit the like and subscribe button. Glad to have you here, and all the questions, very solid questions. Glad to see some sophisticated traders out there. And again, if you're looking to trade, because JJ is going to be talking a little bit about options. If you're looking at options trading, definitely check out CoinCall, a great place to be placing those trades. I know for some of you out there, you've asked about jurisdictional areas. That's beyond our control, but for those who can get access to it, it's a great place to trade spot, perpetuals, and obviously options with a really clean interface and competitive fees. You can follow along as JJ walks through the interface. A great place to do that. Okay, let's get a little bit into positioning. So I want to start with you, JJ. You know, we've cautioned people several times about this run up, about getting into positions, about it's very difficult to do that. And obviously, it's like with anything else, it was, you know, the best trade was months ago, weeks ago to get in. But as we continue to see these flows, we talked about ETF flows continue to be strong. The basis trade continues to be strong. It seems like at some point, if we're getting into a new normal, you're going to have to think about your trades differently. So talk through that. Is it still a time to be patient, waiting for the ultimate setup, or are there still options now, no pun intended, to make some trades and earn some yield?
I mean, there's always
just
a trade to make, right? But it's varying levels of risk that you're incurring. So anytime you're trying to go long an asset, like just look at this Bitcoin chart, right? You're trying to go long it. At this point, you have to be prepared for kind of a retest down to here potentially, right? So this is your margin of error, right? The downside is very steep. And how much upside are you playing for? Are you playing for 80K, 100K, right? And you have to weigh that against, well, this could go to 50. So you always have to have like firm in and outs in your mind if you're trying to get long something that's this far extended. But there are options to do it, like we were just discussing. Like if you think Bitcoin's going to 80K plus, and you look at those miners, I think they'll bounce back, and they'll probably, like, they got sold off on that news that there's going to be this increased tax, et cetera. But if that all of a sudden that news cycle changes and Bitcoin's above 80K and it's a bull market again, and everybody's celebrating them, these things will go and take out the highs, and you get an easy 30% on that, right? And you don't have to hold it forever, but this is just kind of a quick trade you could take if you think Bitcoin's going up, because that beta comes into effect. It's just a volatile asset. I wouldn't read too much in, if you're not holding it for long term, I wouldn't read too much into things like the halving and this presidential announcement. You're just looking at it as like, okay, it's oversold. It's reaching this key support level here, the 50 RSI resistance. Bitcoin's in a major bull market. It's making new all-time highs. It's probably good for a bounce, right? Mm-hmm. And you can get a nice quick percentage on that. So there's always opportunities to play, but like we said, it's varying levels of risk, because if Bitcoin reverses below 70K, I mean, you could see these things, Mara could fall to $15. So you have to be aware of your downside, especially when things are this overextended. But obviously, don't let that lock you out of opportunities.
I want to ask specifically on narratives, because I think the question from Adrian's an interesting one. First of all, it's a proposal that's come out from the White House, and for those who are listening, I think it's still very early days of what it would be. There's been several discussions at a policy level about taxing miners differently because of their energy consumption. And so this is the latest time that this has come out, and there's always this narrative that can be used to sort of trace, you know, the markets and what they're talking about. I could see where this narrative comes out. It continues to push on the miners for a little bit, and then what you start to see is a narrative changing at the same time that the stocks start to rebound a little bit, right? A deeper discussion about, well, we can't really, it's not really effective to tax that. There's going to be people pushing back. How much stock do you give into sort of those narratives as being any kind of signal that you can start to, I guess, have confluence on a trade?
They have very short shelf life, right? So these things get priced in immediately. Like basically, as soon as you saw that news break, it's already down 33%. So your window of action to get short on this in lieu of that news, it's gone, right? It's already priced in. Now you have to start factoring the pendulum swinging back the other way. Inevitably, there will be something like Mara sues the government or whatever, right? Just think of the narratives that could come up. And when you see stocks get beaten down this quickly, typically there's that pendulum effect where the news creates a movement one way, and then counteracting news creates the narrative the other way. And in your mind, you're like, oh, well, I thought these are going to zero because they're taxing their energy consumption. But then it bounces back, and then everybody's like, they're going to win the case, and it goes up to 40, and then more news comes out, and they say, oh no, they're increasing the taxes even more, and it'll go back down. So it's just, you can't put too much stock into it, because it's a market, right? And those news events are often centered around positioning. is that market makers release them at opportune times for them. So you have to be aware of kind of this, for lack of a better word, manipulation factor that goes into markets. Learn to use it for your advantage.
I was going to say, I think when you think about these stocks, I think the thinking here is they're definitely not buy and hold, they're buy and trade, looking for opportunities to get out, take your profit off the table, knowing that they're volatile and they're going to act and be very sensitive to this kind of news cycle.
It's no different than an altcoin, a meme
long.
coin. You know what I mean? You get a 20 to 50% gain in a couple of days on these. Just forget about it. Take your profit.
Yeah, take it off.
And get out. Wait for it to reach your levels again, and that's it. You just look at it as a trading vehicle. It's not an investment.
Okay, so there you have it. A couple of ideas and perspectives from a trading point of view from JJ. Ben, I want to come back to you. You know, again, we had this question around ETH, Sol, Link, or INJ. I don't really want to go into which of those we think is going to outperform. I think, David, we have done some videos in the past about which we thought would actually outperform. We did one comparing Sol to ETH. I think we may have even looked at Link. I'd have to go back and look at all the show notes with everything that we've done. But I guess, Ben, from your perspective, when you're asked this question and you're thinking about not really trading, as more JJ is talking about, more perspective from a longer term investment, how do you think about that question of allocating capital?
I've gotten burned. I've paid my tuition. You know, I've had alerts wake me up, 6 times throughout the night for, trading positions. And it's tiresome, right? I don't enjoy playing altcoins. I don't enjoy the meme coins. I enjoy looking at the fundamentals. I enjoy looking at essentially what is happening with its supply, what is innovative that's taken place that could create essentially this new use case for tokens that we haven't seen. And that's what I like to kind of look at when it comes to new projects or new ecosystems. As far as looking at a specific token and having allocation towards it, I know I get labeled as this ETH maxi, and I kind of want to explain where that comes from, because
the tattoo, that's where it comes from. It's the tattoo.
No tattoos, but to be clear, it has to do with the structure of its tokens right now. If you think about ETH as an asset, it has a lot of use cases that's happening. It has eigen layers, so now people can go ahead and rent the security of ETH tokens. ETH can go ahead and earn the secondary yield attached to it. This was the Cosmos narrative for a long time. I was a big Cosmos fan when it was first emerging, and I really liked the shared security model. It didn't really do much outside of that, and that was in part, I think, some of its downfall, and it hasn't really regained strength to overcome it. But when you go ahead and you look at ETH, so on my screen right now, I have token supply strength. So I'm giving a little tease for what's coming out of JLabs Digital. We're getting ready to do token ratings reports. These are going to be kind of formal sell-side research type of reports. And we were busy over the past 4 or 5 months constructing these models. And these models are based upon our token framework that we developed eons ago, it feels like. And so what it does is it goes ahead and it rates the strength of each category for a token. So one of which is token supply. Is the token being used? Is it being locked up? Is it going towards higher forms of usage in its ecosystem, in its native ecosystem? That's very important because it creates sort of illiquidity. We talk about supply shocks, demand shocks, all those things. But at the end of the day, if a token starts to go towards higher forms of usage, its drawdowns are less and its upside movements are greater. And this has to do with its inelastic properties in terms of a one unit change of demand creates a greater than 1 unit change in price. And that's all it has to do with. So you create higher forms of usage for a token that creates these tokens that are more illiquid or kind of not in supply, not hitting the market. And so with Ethereum, on this chart, you see a lot of dark green of late. And that has to do with these tokens starting to shift their usage to these illiquid manners. Now layer in the fact that it's going to have essentially negative supply growth over the next year. And as the bull market starts kicking into high gear, this negative supply growth is only going to grow in terms of how severe it is. Okay, so I've never seen this setup before in crypto, ever. And that is why I've been so adamant about ETH of late. Is that going to change in 2 years when the cycle? Yeah, probably it will. Okay, I'm not married to any token. I've been a Bitcoin maxi for a long time. I don't want to say maxi, but that used to be a coin I was very adamant about. And Ethereum, I was also big supporter of. Solana when it came out into the scene, I was a big fan of it as well. So I'm not afraid to move. I said Cosmos as well. I'm still following them and Zaki and what he's building, all those tools. But as far as these dynamics, I've never seen it so strong for a token. So I'm very interested in how severe of a movement we could see to the upside when it actually hits. And so I don't want to FOMO it. I don't want to not have exposure to it. So as far as answering questions of coins, like right now, this is in terms of a risk adjusted setup, this is like the best one, like head and shoulders that I could find.
It reminds me a bit of Bitcoin too. Like, remember how often the supply squeeze meme was thrown around and it almost became a joke, but now we're actually seeing it, right? And it's like people say things so often that it kind of gets forgotten about or taken for granted, and then it actually happens, and you see the effect on price when you have just this unlimited demand meeting something.
Absolutely. And typically when we think about prior to this ETF move, it was always supply of tokens that haven't moved in over a year or 2 years. And this had to do with tracking UTXOs on the chain and using these HODL wave charts, which big fan of. It's a good way to see kind of these dynamics fold out in terms of data. But that was kind of this supply shock mentality that people would talk about. Like there's just coins that are getting eaten up and they haven't moved. There's not much supply. Then you have the halving, and that's going to create this reflexivity move to the upside. Well, with ETH, it's not just who's holding it for over a year. It's how many tokens are sitting there and earning yield and going to these higher forms of usage. That doesn't really exist with Bitcoin. I'm not trying to bash it at all. That's just what it is. And so we haven't seen a token go through this positive reflexivity move to the upside that has these characteristics at that time. So that's why it's so appealing. And if an ETF happens, ETF happens, right? And I've made a tweet about that. We can talk about that till the cows come home. But
yeah,
that's where I sit as far as why people label me as an ETH maxi at the moment.
Okay, I hopefully that gives a good perspective on how to allocate capital. I'm going to just add a point to this as we start to wrap up today's show. I think obviously if you're looking at other analysts and perhaps even some of the people which oftentimes are called more influencers, if you will, on YouTube and other areas, they're going to talk more about ones that can get straight gains. And I would just come reference back to the point. I think Ben is thinking more from a fundamentals perspective, and honestly, a lens I don't think has really given this much analysis before. What Ben is rolling out with the token supply strength. Obviously, people have talked about locking up tokens in proof of stake vaults, etc. But this is something new, so I think it's something to watch. Definitely, I think the risk adjusted element is what we're trying to cover here. Give people more of a deeper, sophisticated perspective when they can think about allocating their capital, because the last thing we want to do is for people to be up at night worried about having their capital sitting somewhere. Okay, with that, we are going to wrap up today's show. I want to thank everyone for joining us today. Hopefully you got something out of here, and definitely if you've got ideas on the show time, really appreciate dropping the notes. I know a few of you already did, because we're definitely trying to optimize around that to the best that we can. But with that, we're going to wrap up. Ben, JJ, appreciate you guys being here. As I look at this, the market, Bitcoin's sitting about 72K. Not much of a pullback. Just feels like up only. But I will say, as I always do, my PSA, if you don't have some dry powder, get some, and always be prepared for whatever the market's going to give you. This is Marconi White signing off.